The following video there where are going to present about the financials. Introduction. The majority of the people is interested in one or another way in financial for some resource, especially the money. The desire to climb socially, improve the quality of the life and the give in better opportunity your firstborn. A theory of price from the supply and demand relationship consumer, the capital market and the taking of decisions which should be processed a number of economic variables. The financial is between the two relationship and economy and accountants. The relationship with the accountant is established because of the supplied facts about the financial health of the company through accountant reports. The financials and the nexus of economic and accountant because they connect the theory of economic with the features brought in financial state. The financials aims to offer an overview of financial and the objective of study where are the objective on administration finance and the principle that give is action. Objective of the finance. Finance represents a branch of economy that deals with the matters concerning the value. The objective of the finance is to maintain the wealth and shareholders. The concept of maximum value general and question of the measure is the company oral or destroy value. The profit involved two big reasons. First, the term gains mean that they can be short or long term. Second, earning ignore the value of money and the risk taken to obtain them. Where are the costs and actions of those managers and shareholders have the same goal? Is it when the shareholders hear manager or administrator exercise the administration of the company? If the administration does not carry formal investment, then shareholders must spend on the net to monitor the action of the administration. If we talk about corporate finance and finance management refers to the investment decision, which very often and for various reasons will analyze so that the first asset must be purchased, that value must the greater that is cost to increase the value of the actionary. I continue. Are there three types of finance? Finance decisions determine how that first finance investment decision and the right side of the balance lies. Finance investment is the one where transactions are made by accountant and other of the third party which does not belong to the organization but the customer. Capital market the scope where a series of financial instruments called title of values which can be bonds, stock, corporate bonds, and derivative products are traded. The vision of company. The visions of the investment mechanics. There is exchange of money and real assets to channel investment, provide the framework on the analysis to see how the fears interacting with the rest of the economy agents. The vision of the accounting model. It is a byproduct of the vision of the mechanism of investment and the concentrates of the structure of assets and liabilities. The overall contract. It is a set of explicit and implicit contracts among these are economic agents with which in the maintenance relation stakeholders. Continue for the functions and the objective of financial manager. Capital budget, capital structure, work capital. Capital budget finds those investment opportunities that generate value to the company. These types of the decision requires refined calculus and measure of profitability. Capital structure. This is an optimal mix of the action and the maximum the value of the first minus the value of capital and the working capital. The efficient sculpture operative purely in the short term. Primary and secondary capital markets. Primary financial markets are those where the exchange asset the nuclear create. In secondary markets do not create new debt or their new action, simply change to the owner of a financial asset. Credit market a set of transactions performed by intermediaries that obtain much of the their resources through the collection or deposits. Markets or capital and monetary markets. Money markets are those in which the titles with the interior of the year maturities are negotiated while capital markets are negotiated long-term titles, such as obligation and action. Finally, and the point where referred to the globalization usually used for the global effects or international trade and cash flow. We live in a world where financial transactions have become globalized. Today it is a much easier to move capital quickly to other places in the world and the transaction costs. Uh, Finally, managing accountants for focus on forecasting. They have gone exciting and forward-looking strategy role in many different types of organization. Many trained managed accountants and head or top businesses in a which varieties or roles in them demanding financials analysis or financials director. The contribute to decision making across the organization. The analysis the probably is vital in taking business forward.
From EBIT to net income. Immediately following the EBIT operating result, a series of items that represent the effect of financing, other income and expense, and sometimes extraordinary resource appear. We discuss them below. Financial result, normally divided into liabilities and generated by assets, but comprise mainly interest, exchange difference, price difference, holding results, and inflation adjustment. Other income and expense are those income or expense that do not have a specific classification within which we have seen as administrative, commercial, or financial expense. Extraordinary income refers to extraordinary income or expense such as the sale of fixed assets, indemnities to employees' claims. Corporate income tax. Finally, if the firm shows profit after having subtracted all these concepts, it must pay corporate tax. The note to the income statement and the annex. The note and the annex to the financial statement clarify the composition of the items from a more detailed opening. If it is not distributed as cash dividend, it could be capitalized by distributing a dividend in share, constituting a reserve, or simply keeping it within a retained earnings account. In any case, it is always retained earnings that are reinvested within the company. The balance sheet reports the equity position of a firm at any given time. Normally, the balance sheets are presented on an annual basis, and the case of listed companies on a quarterly basis. The active assets are listed by decreasing degree of liquidity. First, short-term assets called current or current, depending on the country, consisting of cash and bank balance transaction investment, such as term deposits and bonds, after sales and inventories. The liability shows just how the company finances its investment and represents two types of rights over the assets: liabilities and equity. A grouping under the accounting figure of equity. Equity or equity. Equity is equal to the asset less the liability. Is the shareholders will receive if all the assets are sold. Common shares and subscribed capital. Common or ordinary shares represent the true ownership of the company, as it is the common shareholder who make the capital contribution, assuming the risk of the business. Favorite action. Preferred share represent an intermediate point between common share and debit, since payments to the preferred shareholder consist of a fixed dividend. Retained earnings. The balance of retained earnings reflects a gain of current account of the company over time, grows if the company self-reinvested in itself, and decrease if it pays cash dividends.
Working capital. From the accounting point of view, working capital or working capital defined as the difference between current assets and short-term liabilities. However, working capital is far from static. On the contrary, it's constantly changed, and sales are generated on a permanent basis, and with them the accounts receivable and the purchase of inventory with the following account payable. We could say that this movement begins when products are invented and then transformed into products in process until the final products are obtained, and then the company sells to its customer with a profit margin. The financial statement or the report of the financial statement of the firm remains today the document that best summarizes the financial activities of the firm, and the firm requests the banking analysts, consultants and research when looking to analyze the economic financial situation of the company. However, this information is only a starting point, and for good reason. They often do not provide critical information for decision making, and as we will see, financial statements may have major limitations in communicating the situation. Depreciation methods use fixed assets such as a plant or machinery to produce goods. These assets lose value with the use and the passage of time, or by technological obsolescence. This decline in value is a cost of production and therefore must be reflected in the income statement. As we have said before, public accounting use several methods to reflect this depreciation in order to spread the cost of the goods over what is considered its useful life. Research and development expenses and advertising expenses as an expense within the period in which they were incurred. However, often these expenses are more like investment than real expenses. An advertising expense is made in order to generate future sales. The research is carried out with the aim of developing a new product. In both cases, there is an association return. It is spent today in order to collect more money tomorrow. Every time there is inflation, begin the complication to show the actual result and financial position of the company. While these distortions have been mitigated by adjustment for inflation, they do not reflect the true impact on the company, because the financial statements are recorded in monetary units on the dates they are made. They add currency with different purchasing power. Inflation distorts by the balance sheet items and the income statement. The evaluation of the currency distortion factor is found in those countries that have devalued their currency. Such measures often break on balance sheet because strong devaluation takes place over short periods. Income transfers are often varied. For example, a company that exports most of its production and also has all its debt in national currency would, in principle, be greatly benefited by a devaluation. But the opposite would happen with an importer or with a company that has its debt in foreign currency. In fact, there will be a result of exposure to devaluation that will affect both assets, receivable, inventories, and liabilities, accounts payable, financial debt, and of course their result. Taxes are involved in almost every decision. The state is like a dinner rather than taking a portion of the pie representing the company's profit. There are numerous situations in which the tax effect of financial decisions can create value. One of the most important refers to decision of the capital structure, where debt offers clear tax advantage since the legislation allows the deduction of interest as an expense of the period.